teach a totally different kind of program for people who come to my workshops. All right. And so I'm going to summarize how do we invest well when markets are trending up and markets are trending badly. So the all-weather investing, all right, comes in 4 parts. All right, trend following, mean reversion, dynamic bond, and short. Okay, so I'm going to explain to you 4 of these approaches one by one, so you sort of understand what it is. Now, collectively, they cover most of the trading techniques that are taught, okay, by many other like course providers. All right. Okay. So how do you do well in all markets? Now, the first is trend following. And when we do trend following, we're buying an exchange traded fund that over the long term is profitable. If something is trending up, we buy, right? If something is no longer trending up, we sell. Okay, right. If you do trend following and you benchmark against the 60/40 portfolio, you will find that our annual return is 18.4, our Sharpe ratio 1.41, and it is about close to 40% higher than our index, which is a 60/40 portfolio. All right. So over the long term, this is a very profitable strategy. And the fundamentals are like Newton's law. An object in motion stays in motion. All right. So when we are employing a trend following strategy, we're trying to exploit long-term trends in the market. We comb a set of exchange traded funds covering all major asset classes. We buy those with the strongest upward trends. Okay. So that's a basic basis of trend following. All right. And how does it work? Okay, an example would be in 2020 at the start of the pandemic, a trend following system, an algorithm, a Python program, is smart enough to move everything into treasury bonds when the market is crashing. And then it moves back into technology stocks when the market has stopped crashing. All right, so it's moved into treasury and then it moved back into technology stocks, right, in response to this particular section of the graph. All right, so you can write a computer program to figure out how intelligent it is that it's able to do this. All right. Now, a good trend following strategy answers very important questions about crypto investing, right? Cryptocurrency is very volatile. It can go up very quickly. It can go down very quickly. So if you were to use a trend following algorithm, what it can do is that it can tell you when Ether or Bitcoin begins to trend, it will begin to put its money into crypto automatically. So you don't have to think so much about, how do I position my money into the cryptocurrency markets? And the returns are pretty awesome, right? I've shown you the return results just now. Okay. All right. So basically, trend following works fairly well with crypto. Okay, crypto ETFs. Crypto now has exchange traded funds. You can buy off these brokerages. No need to use a specialized wallet or MetaMask to contain your crypto. Now you can do it using a normal brokerage account, right? Of course, just Bitcoin and Ether for now. Over time, there will be more like Solana, but generally speaking, these are the 2 crypto ETFs that we deal with, right? So this takes away the guesswork from thinking about whether to play with crypto or not, all right? So that's trend following, okay? We follow a trend, we follow the herd, right? And we step away when the excitement goes down. The second strategy is the opposite of the trend following strategy. It's known as a mean reversion strategy. And mean reversion is the opposite of trend following, right? Trend following, we buy something that is trending up. Mean reversion, we are buying a short-term oversold stock that is profitable, all right? Now, if you were to adopt the mean reversion kind of algorithm, your returns is actually lower than the competitor, which is the Standard & Poor's index. But with mean reversion, we can reduce the standard deviation or the risk of a portfolio by a significant amount, by as much as 33%. So because of this, we are able to produce mean reversion strategies that have a Sharpe ratio of very close to 1, right? Which is a lot better than what most financial advisors can provide. Okay? How does mean reversion work? For every action, there is an equal and opposite reaction. When the market's trending up, we look for a stock that is temporarily oversold. We buy it at the bottom, and then there is a high probability that it will rebound. Okay? All right? Same thing. There's a program to actually do that. Okay? But in practice, what it does is that the algorithm would look for blue chip stocks that are temporarily doing badly, like Procter & Gamble, Johnson & Johnson, some oil companies, some spice companies, and they will allocate the amount of capital into it like a very conservative kind of fund manager. All right. So that's what the algorithm is designed to do. Okay. And the truth is that the majority of these blue chips bounce back. Some blue chips would actually lose a certain amount of money and then you cut your losses. But the majority of these blue chips do bounce back. So it earns you, on average, a very decent kind of return over time, right? At a very, very reasonable risk. The third strategy is less important, but for those people with a large amount of capital, you might want to concentrate on putting your money into bonds, right? And for a bond fund, we can't be too greedy when it comes to returns. So the dynamic bond fund only produces 2% returns, but it's got a standard deviation of much lower than our index, which is the aggregate government bond fund. And so once again, we're getting a Sharpe ratio that is way higher than our benchmark. What it does is that when interest rates are rising, we shift our allocation to short-term bonds, right? The bonds that return your capital within a year, right, to 3 years. But when interest rates are falling, we will spread our allocation across different bonds with different maturities. Okay, so yeah, so you need a computer program to actually perform the allocation for you, right? And so, you know, when interest rates were rising in 2022, what it would do is that it will shift its assets automatically to short duration bonds. Okay, and finally, totally optional is a short strategy, right? In a long-term decline, when you sell an overbought exchange-traded fund, right, you can produce returns that can diversify from other strategies. Because when markets are very bad, there's a crash or a recession, short strategies will become very important because they produce a positive return when everybody else is losing money. So in this case, there is no benchmark, but we can produce a positive return of 1.8% with a very low standard deviation. So creating another high Sharpe ratio kind of strategy, right? Positive returns at a decent risk for folks who want to make money in down markets, right? So we just need to outrun the bear. Where the overall trend is negative, we buy exchange traded funds where the long-term trend is still going south, but it's temporarily positive, and then you short it, okay, and then when it's gone down a little bit, and then you buy back. Okay, a good short strategy should seldom wake up. Most of the time, the program will tell you not to short anything. Over 5 years, there are only 98 trades, okay, but 58% of these trades are positive, right? So a good short portfolio has the ability to generate results like this. So bottom line is, what does it mean when we have an all-weather portfolio, right? It means that we have a system to mix these 4 strategies together based on our needs. And while the numbers are not particularly impressive, the return is about 8%. What I want you to emphasize on is a standard deviation of 3.75%, which is very, very low. And you can achieve a Sharpe ratio above 2. Okay? Now, you also halve the drawdown. From about 35%, you halve it to 18%. It means that your portfolio doesn't lose a lot of money when times are particularly bad. So this is something that is very forgiving for beginners. You can achieve 49 good years for every 1 bad year. That means out of 50 years, you make money in 49 years, right? 1 year is particularly very bad. Okay, can't help it. You must be really unlucky to encounter that year. But even in that case, your losses are going to be very small because of how defensive these 4 strategies are when you combine them together, right? And for folks who think that 8% is not an impressive number, do note that experts can apply leverage to get this number up to a double-digit number by using a margin account in these brokerage facilities. All right. So this is how we can achieve stability. Okay. And over time, this is how the portfolio looks like compared to its benchmark, which is a 60-40 kind of portfolio, right? The line in green, all right, it has the ability to be able to move up and produce a much better returns over time, right? Okay. So what is the solution to the all-weather investment portfolio? If you want to do well in the markets, regardless of different market conditions, then you really need to combine this trend following mean reversion dynamic bond and short portfolio into one. Okay. And depending on whether you're willing to leverage up the portfolio, you can actually boost your returns, right? If you know how to play this properly. Right? So I've enlightened you about how we actually approach our program. Okay. All right, so let's jump in and let me talk a little bit about the All-Weather Portfolio Masterclass. So this is a 2-day course. All right, it runs at the end of August, 30th to 31st of August. It is a 2-day course to build a portfolio that does well in every market cycle. Okay, and its objectives are to show beginners how to build a core portfolio that does well in all market cycles. Learn how to use computer programs to make decisions that are not biased by personal emotions, right? And then build a secure lifestyle around a source of wealth that grows steadily over time. What is the outcome we want? We are in essence building 4 different strategies: trend following, a mean reverting, a bond portfolio, and optionally a short portfolio to profit from market downturns. Okay, and this is how each lesson is being conducted in my program. I will first explain the investment theory. Very important, right? You need to understand how the theory works, covers how the theory is derived, what behavioral weaknesses we are exploiting, what is the strength of a particular strategy, when does the strategy fail, right? Yeah, like for example, in this case, it's a slide to explain what does it mean when something is trending up, what does it mean when something is trending down. A little bit mathematical, right? But you notice that the mathematical symbols are not complicated. Okay. 2 is once we are ready to deploy our sums into the money, into the portfolio, we don't act so quickly. We perform a backtest. We simulate trading strategy over the past 10 years, and you download the historical data from Yahoo Finance, and we tune, right? We change numbers to get the return that we want, okay? And we make sure that the strategy is something that we are comfortable with. All right, so that's the second thing that we do. Then the third thing we do is obviously we need to tune, right? The investment advisor, we know these things work in the markets. We need to adjust the numbers. There's no coding, right? It's just adjustment of variables, okay? And once you perform the investment advisor, you run it, and it will tell you what stocks to buy, right? And each strategy will have its own rebalancing frequency, the execution guidelines. How do you manage your trades, right? How do you make sure that you don't lose too much money in the trades? What kind of orders do you give to the broker to execute your strategy, right? So that needs to be taught as well. Okay. All right. So why is this course unique? It is cross-domain. It involves financial concepts, and there is some programming. You don't have to do programming, but you need to know how to run a program. Okay. So finance professionals can learn a little bit about how to leverage technology to actually advise on trades. Folks who are IT professionals probably benefit the most. You can learn a little bit about finance, and how to actually tweak the programs to make it work for you. All research is reproducible, okay? And students improve their own code after attending the lessons to make even more money than the portfolios that I benchmark and I share with my students, okay? All right, so once again, okay, the returns are humble, but if you're willing to use leverage, right? If you were to double the amount of money in your portfolio at a financing cost of 4%, you could be getting returns of up to 12.2%, okay? And the standard deviation is like 7.5, which is lower than many equity portfolios, all right? So the beauty of portfolios like this is you don't need to leverage, but if you think like a hedge fund manager, what they will do is that they will borrow some money and they'll try to increase their returns further to get a double-digit number that they're comfortable with. Okay? Okay. So with all these things being said, there might be some idea that this is a very difficult course. It requires some programming knowledge, but that's not true. Okay, you don't have to do programming to operate the programs that I write. All you have to do is run it. Okay, so I'm just going to do you a demo of what most of my students do to actually make the program work for them. All right, so I'm going to stop my share. And I'm going to share, I'm going to share, oh, hang on. Right, so let me just get my screen up and running. Okay. Okay. All right, so this is how my program looks like. All right. And this is how typically you need to get the software to work for you, right? You upload a program into this thing called Google Colab and you click the play button, right? So the first program will already load up all the libraries, all right, that's required to run it, okay? And then you go down to the next cell, you click play again. And what this do is that it will pull all the information down from Yahoo Finance, all right? And then you go down even further, you click to load some of the key functionality that's required for the program. You don't really have to understand how all this works, right? You just need to understand the finance and the theories behind it. And what the software will do will tell you that, you know, for the past 10 years, this is how I would allocate my funds across these ETFs, right? Scroll down even further and you click. And what you do is that you tell you for the past certain number of years, this is the performance of this particular strategy, 17% every year, 13%, you know, high Sharpe ratio, all right? And this is how your portfolio will look like relative to the index that is its benchmark, okay? And then scroll down even further, which is the most important part. It will tell you that if I'm putting my money into the stock markets right now, how do I allocate my funds? And this itself is a very useful lesson on what's trending in the markets right now. So right now I've run this on the 20th of August, right? And gold is a very good place and it recommended about 35% to put into gold. China stocks are doing well. There's a rebound, 20% into China stocks, all right? BUS is a special ETF that's sentiment driven, okay? So it's done very well in the markets. But interestingly, the algorithm is brave enough to put 16% into Bitcoin and 9% into Ether, right? And that's in response to the Genius Act that is enacted by Trump, okay? Now, I know some people are concerned, say, you know, Chris, you know, why do I want to run a program that's going to put 15% into crypto? Yeah, but you don't really put 15% to crypto all the time. We run this and we rebalance this every month. So crypto is only in the portfolio maybe 1/3 of the time. All right. So the overall risk of the portfolio is actually very low. Okay, and that's all you need to do. You notice that I do not do any coding. I do not make any changes to the variables in the program because I would have done the tuning for the student. Okay, and that's all you need. Okay, and this is how the trend following algorithm works. Okay, all right, so let's get back. Okay, so that's a very short demo. Okay, we will be sharing 4 programs like this. That's trend following, mean reversion, dynamic bond, and short. There is a 5th program to tell you how to coordinate between the 4 programs because you want to simulate what happens when you put, for example, 20% into trend following, 5% into short, and then you'll be able to produce a lot of results for you. All right, so this is how you consolidate everything into a very powerful system, all right, that lets an ordinary retail investor, you know, function as well as a hedge fund manager. All right. So some of the questions is it easier to learn from books? Okay, I don't think a single book can generate an investment cost like this, right? In fact, when Dr. Wealth told me to convert a book into a course, the book's formulas all failed, right? Because the book was written in the year 2013, it's more than 10 years old. So I had to change the formulation of the code, rewrite the program to actually get it to produce good results. All right. And so that skill is very rare, right? Because you need someone that is strong in finance, knows a little bit of coding in order to produce a program like this. And more importantly, to be interested in actually teaching it to somebody else rather than keeping the formula to yourself, right? So yeah, I can share the books. The books are here. You can actually Google it, all right? The next question is, why would a successful trader share his secret sauce with other people, all right? So the first point is that this is only shared with an intimate group of paying customers. This is a very small community of people who are interested in looking at a new way of investing, all right? But the fact of the matter is that my students have, over successive course runs, they've improved the performance of these programs and were kind enough to share with me. So the first batch, I introduced cryptocurrencies. Then the students suggested adding China technology stocks into the universe, so I added China and India into the mix. And the second batch of students added more and more ETFs to actually gradually improve the overall performance of the portfolio, right? So this is not so much of a guru telling students what to do. We are all working on software and we are all trying to make more money together, right? And so we function something like a hive mind, right? Okay, so who are the biggest beneficiaries of the program, right? This is not a programming course. Students need to learn how to operate a Jupyter notebook, right? Which is a program I've shown you just now. Just click play, right? If you want to benefit from the program, you should have a Gmail account, obviously, so that Google Colab, you log in using your Gmail account, right? So you don't need to really sign up if you already have a Gmail account. Obviously, if you know a little bit of programming, the biggest benefits go to you because you can modify, you can improve the code, right? And the Facebook community is designed to attract a team of like-minded people who are interested in learning how to make money with the code written by others, right? Okay, so this is what you will get when you sign up for the masterclass, all right? 2 days of training where you gain access to 4 strategies: mean reversion, short, trend follow, and treasuries. These 4 strategies have a very low correlation with each other, right? So combined together, that's how we can get such a high return and such a low standard deviation, all right? Whoever needs to do this needs to be very interdisciplinary. And so you realize that you probably need years of training in programming, right, and finance to be able to write programs like this. Okay, and even if you were to do this in a very intensive manner and you get ChatGPT to assist you, I still think that there'll be 6 man months, all right, at least to even understand the finance theories behind these strategies, right? Next, we'll provide a list of every single strategy that's being taught. And so there's a list of ETFs required to feed into the programs. We will share that with you. On top of it, I will explain to you the expense ratio to ensure that how much you spend on the strategy is going to be very low compared to, for example, buying a product from, for example, a financial institution, all right? The third benefit is that we have a Facebook community, and this is very important, right? When you have a Facebook community and you have students coming in together, and we're dealing with things like computer code, these codes occasionally break and require debugging and fixes. The code broke about 1 hour before I started attending this course, but I debugged the code. I've amended it so that I can do the demonstration to you, all right? But generally speaking, I will always update the latest version of the code into the community and everybody gets hold of it for free. We do not charge membership fees. Once you pay for 1 round, you join the community, there is no advanced cost, right? The only advanced cost that's closest thing is my other course that I conduct with Dr. Wealth. And a significant population actually are students of both courses. But every course is self-contained, right? Yeah. So I think the most important thing is that the codes occasionally require maintenance, libraries change, but there's always somebody to make amendments, to make sure that the code that you get is always fresh, all right? Obviously, you get every single strategy taught in the course, right? You don't need to learn to program. You're just editing a few variables in the worst case. right? Now imagine if you get a third party to write these algorithms, it costs you a bomb, right? Yeah. And the worst thing about getting ChatGPT to write this code is that you need to phrase your prompt very well because the code will run, but it might not make you money, right? Which is the biggest problem in the IT and finance kind of interface, right? Programs can run, but can it make you money, right? Okay, and obviously we have regular updates through our community. Every week I will adjust the portfolio and I'll update everyone. Okay, because I do it for myself and I got a portfolio running, the updates come for free, right? Once you pay for the course, there is no membership fee. All right, so let's summarize everything that you will get. Okay, now easily the value of the course is a nice 5-digit sum, right? And if you were to put a 10% sort of cost to the program, then it'll be about $6,488 per head. But we want to build a community. So the fee, if you demonstrate your interest to Dr. Wealth and say that, hey, I want to sign up for this program, Dr. Wealth puts up a link, right? Then it will cost just 1,888, right? It's 2 days of training after all, okay? Uh, and we're really trying to really work up, this new form of this new age form of actually investing in the markets. Our program will run on the 30th of August, right? We will conduct finance fundamentals, right? Market exploration and trend following strategies. And then on the second day, we will cover bond strategies, mean reversion strategies, and short strategies. And we will put everything together in the final chapter before we call it a day. All right. So it's over a weekend. You start at 9:30 and then you end at about 3 to 4 o'clock every day. Okay. And on the second day, you would have learned all the strategies. Okay. Okay, and so this summarizes everything that we have. All right, the 2-day workshop, the date is not accurate. We are running a course on the 30th to the 31st of August, right? $1,888. All right, you can enroll now. Okay. If you come for the first day of the course, you're dissatisfied with what you're learning, you feel that this course is not for you, then feel free to exit. We will refund all your money back, right? And just don't come for the second day of the webinar. If you act within the next 72 hours, we have a free package. It includes all the books that I've written so far with investment articles for beginners. And there is also a bonus lecture on a beginner's primer to Google Colab. So you will have a little bit of foundation on how to upload something and run it in Google Colab so that you have a little bit of background. It'll be easier for you to get started on the first day. Okay, 30th to the 31st of August, 1,888. And let's proceed to have a Q&A. All right, we've got a fairly decent Q&A session the last time round. Okay, so you can ask me anything. Okay, I know that some of you might be here because of my YouTube presence, so I will answer any question with relating to life, and financial markets. Okay, all right. Okay, Tan Sui Hee, thank you very much for the kind gesture. We'll deposit the funds and email you. See you next weekend for the all-weather class. Thank you. All right, Ignatius Tan, yeah, Dr. Wealth will send you the link to the recording. Okay, and let's see. All right, Warren, when was AWP incepted? It was incepted approximately 2 years ago, and our results so far is similar to our backtest. So we have a time-weighted return of about 16 to 17%, right? Includes the timing of the Trump tariffs. So I would say it's not too bad, right? The results we will share in the actual class, okay, but it has met the same backtest results that I've demonstrated to you just now. All right, so every year it's about 7 to 8%. Okay, but the individual strategies, they do well and they do badly. They don't do well at the same time. It's designed to be that way. So right now, the trend follower is doing better. The mean reversion algorithm, it's barely breaking even. It's barely breaking even, right? So when combined together, the results are not too bad. Okay, yeah, yeah. JJ Tan, do I get a discount if I was a Dr. Welf student? Talk to Dr. Welf about it. All right, talk to Dr. Welf about it. There will be a discount scheme available for you. All right. Okay. Okay, okay, this is a little bit confusing, right? If you want the options course, you have to sign up with Weibo under Dr. Web. I don't teach that course, and I don't do options. So this is not an options strategy course, right? This is a course that focuses on the US markets. It's got a strategy for ETFs as well as US stocks. All right. So I do not cover options in my all-weather portfolio class. Right? Okay. All right. So Warren, yeah, I understand US ETFs have an estate tax above 60K. Yes, if you invest your money in the US, it's not the same as investing in Singapore. If anything were to happen, there is estate taxes. In fact, if you collect dividends from the US, there's a 30% withholding tax as well, right? But because we deal with ETFs, the dividends we collect is very, very small, right? It's not like the dividends portfolios I build with my other class where we get 6 to 7%. For ETFs, the dividends you get is less than 2%, right? Yeah, less than 2%. All right. So the impact is very low. Okay. But I think all US investors know this, right? When you get a dividend, there's 30%. If you pass away and you've got a lot of money in your brokerage, the lawyer will have a you have to resolve your inheritance taxes before you do that, right? So how do you intelligently get the money out? That's a different field. I don't teach that. Okay. All right. JJ Tan, what's the exit strategy? How often do you rebalance the portfolio? So, okay, good question, right? For the different strategies, we have a different rebalancing strategy. The trend following strategy, you only rebalance once a month. So that's the best strategy, right? The mean reversion strategy, you rebalance once a week. Okay. A little bit more work. Okay. The short strategy is highly intense. If you are shorting something at that time, you have to monitor every day, right? So different strategies, different strokes for different folks. For people with a different kind of lifestyle, there is a strategy for you, right? With a different risk and return. But I would say that with four strategies is very generous, and you get to learn how all four of them work. All right. So um, we have a very logical and very systematic way to rebalance, to exit, right? Every single exit strategy is documented for you, right? For folks who know my other program, the Early Retirement Masterclass, we don't have an exit strategy because we are dividends investing. Okay, so there is a very big difference in the nature and character of the two investment courses that I teach under Dr. Wealth. All right. Okay. I think if there are any further questions, right, you can write an email directed to Dr. Wealth, okay, and I'll be there to answer them, right? Otherwise, all right, I hope to see you in my class. It's going to happen very soon, 30th of August, and I hope to see you there. All right. Thank you very much, and have a very good evening. Okay, goodbye.